Hello, everyone, and welcome to another lecture on engineering economic analysis. And in this video lecture, we want to talk about part two of rate of return. Well, so far in our discussion, we have considered only single alternative IRR problems, where an investment is economically justified when IRR of that investment alternative is more than MARR, minimum attractive rate of return. But what we want to do in this lecture, we want to start talking about multiple alternatives. And the point is, when you have multiple alternatives to decide which one is the best, we cannot simply choose the alternative with the greatest IRR. And I want to emphasize on that we cannot simply choose the alternative with the largest IRR. Well, at this point, you may ask why. Because in net present value analysis or uniform annual worth analysis or future worth analysis, in all of those we could select the best alternative based on the highest net present value. But why is not the case with the IRR? Well, the reason is present worth, annual worth, and future worth are all absolute measures of worth. They are based on dollar values. But IRR, or internal rate of return, is not an absolute measure. It's a relative measure of worth when you're comparing multiple alternatives. It essentially doesn't take into account the magnitude of the investment. I'm going to give you an example here. Let's say we have two investment alternatives, and MARR, or minimum attractive rate of return that we have in mind, is 10%. Meaning that your money is now in some account, in some type of investment, let's say stock market, where you're earning 10% off of that. And you're deciding whether to take any of these projects. Which one would you prefer? Project A says, invest $1,000 today and receive $2,000 in 1 year. And Project B says, invest $5,000 today and receive $7,000 in 1 year. Well, here you can see that alternative A earns you 100% return on your investment, right? Your $1,000 becomes $2,000 in 1 year. That's 100% return. While alternative B earns only 40% on your investment because you invested $5,000 and you earned additional $2,000. So $2,000 divided by $5,000, that's 40% return. So if you were to select the alternative with the higher IRR, you would go with alternative A. But I'm going to tell you that's not the correct selection. Because comparing these two IRR values does not consider the amount of money invested. Let's dig in further here. We're going to assume that you have $5,000 in hand. Otherwise, you wouldn't consider these two alternatives. You have $5,000 available to invest. If that's the case, alternative A essentially tells you that, hey, invest $1,000 of that in alternative A, and the remaining $4,000, just leave it wherever it is. And wherever it is whether a stock market or any savings account, you're earning 10% on that. Alternative B says invest the full $5,000 in this alternative. Well, if you calculate the net profit here, if you go with alternative A, you're going to earn $1,000 off of that alternative plus 10% from the $4,000 that you remained in your current investment. So at the end of the first year, you will be leaving with $1,400. If you go with alternative B, you're going to earn $2,000 from your $5,000 investment. So clearly, you can see that alternative B gives you more dollar value profit. Essentially, what we're doing here is incremental analysis. We're saying that to go from alternative A to alternative B, you would have to invest an additional $4,000. That additional $4,000 coming from $5,000 minus $1,000. And we call that additional investment an incremental investment. And that incremental investment is going to return $1,000 in profit, right? Because when you're going from alternative A to alternative B, you're going to make an additional $1,000. And that additional $1,000 is coming from an additional $4,000 investment. So for that incremental or additional investment, you essentially earned 25%. Why is that? Well, that is the $1,000 return that you got over 4,000. That is 25%. And what we're saying is, now that your incremental return is 25%, you got to compare that incremental rate of return to the MARR and make a decision. And now, since the IRR of the incremental investment, which is 25%, is greater than our MARR, which is 10%, we choose the higher priced option, B. So this is the way that we're going to do incremental analysis in IRR. And it's the correct way of comparing multiple alternatives using IRR. You got to look at the incremental investment when you're going from the cheaper investment to the more expensive investment. So to put this in a formal procedure, here I have the incremental analysis procedure for you laid out in 3 steps. The first step is you have to order your alternatives based on their initial investment value, smallest to largest. Then in step 2, assume that the initial investment of alternative B is greater than the initial investment of alternative A. We must look at the difference between the cash flows. So here we're saying that alternative A has a cash flow, alternative B has a cash flow, but alternative B has a larger initial investment. So what we're going to do is we're going to subtract the cash flow of alternative A from alternative B. Now we get a new cash flow, we call it B minus A, and we need to calculate the IRR of that cash flow. In fact, we call the IRR of B minus A. Once we calculate the IRR of that new cash flow, we can make a decision by comparing it with MARR. If it's larger than MARR, then we select B as the preferred option. If it's less than MARR, we select A. But here I want to emphasize on a very important point. And that is, this decision rule that we have here is only for investment problems. If you have borrowing problems, where you're comparing multiple borrowing alternatives instead of investment, where you're receiving money instead of investing, then the rule is flipped. These 2 signs are flipped. If IRR of B minus A is less than MARR, then you choose B. If IRR of B minus is greater than MARR, then you choose A. So it's just depends on if you're looking at borrowing problem versus an investment problem. So keep that in mind. But anyhow, you can always double check your IRR analysis by looking at present worth analysis. You can verify your IRR analysis with present worth. In fact, we're going to do it for that example. For the previous example, you can calculate the present worth of option A, which is negative $1,000, that's the initial investment, plus $2,000 that you receive at the end of the first year. And here's the present value of that option. Here's the present value of the second option, and you can clearly see that the present value of alternative B is greater, so you would choose B. And that's what the incremental IRR analysis told us. So you can always verify your work by using the net present value analysis. In the next video, we're going to look at an example to make this procedure more clear.